Money Power Fraud presents Celsius, Yield Promise versus Liquidity Reality. Chapter 1, Executive Exposure, Yield Without Liquidity. Over $20 billion in customer capital was exposed, not through market volatility, through structural design. The system offered yield, but could not provide liquidity. That contradiction defined the failure. Customer deposits were presented as accessible. They were not. Funds could be withdrawn at any time. In theory. In practice, capital was locked. This created a false assumption that liquidity existed. It did not. The system depended on continuous inflows, not internal cash flow generation. New capital sustained old obligations quietly. This resembled yield generation. It was liquidity recycling. The balance sheet appeared stable because liabilities were obscured, not removed. Customer deposits became unsecured exposure. They were deployed across multiple strategies: lending, staking, DeFi positions. Each layer increased complexity and reduced accessibility. Liquidity was not engineered. It was assumed. That assumption held until withdrawals accelerated. This is where the system fails. The underlying mechanism was simple. Capital entered through retail deposits. It was redirected into illiquid yield strategies. Returns were paid using a combination of yield and new inflows. This created artificial stability, but only under normal conditions. When market pressure increased, liquidity tightened. When withdrawals increased, pressure compounded. The system could not unwind positions fast enough because the capital was no longer liquid. This is the structural failure. Short-term liabilities, backed by long-term illiquid assets, a classic mismatch, but without regulatory safeguards. No capital requirements, no liquidity buffers, no lender of last resort, only market conditions, and market conditions shifted. What followed was predictable. Withdrawals increased, confidence declined, liquidity disappeared, and then the system locked. This breakdown follows three phases: how capital was aggregated, how exposure was hidden, why collapse became inevitable. Chapter 2, The Illusion of Safe Yield. The system was positioned as a bank alternative, but it was not a bank. There was no deposit insurance, no regulatory capital requirement. Still, it offered yield, high yield, far above traditional markets. This created a perception that risk was low because access appeared simple. Deposit assets, earn returns, withdraw anytime. That simplicity mattered. It reduced scrutiny. Users did not evaluate underlying mechanisms. They evaluated yield and consistency. This is where perception diverged from reality. Deposits were not deposits. They were unsecured loans issued by retail participants to a centralized entity without priority in liquidation, without visibility into deployment. This distinction was not emphasized. It was abstracted through interface design and language framing. Balances appeared stable. Accounts resembled savings platforms. But the underlying structure was different. The system depended on belief that yield could be generated safely and consistently across volatile markets. That assumption required conditions: stable asset prices, continuous inflows, functional counterparties, and all three had to hold simultaneously. If one failed, stress emerged. If multiple failed, collapse accelerated. This is the hidden risk. Yield was not fixed. It was conditional on market structure, on liquidity availability, on counterparty stability. But it was presented as reliable. That presentation mattered. It drove adoption. It increased deposits. It scaled the system, but it also amplified exposure because expectations were misaligned. Users expected accessibility. The system required stability. Those are not the same condition. This is where fragility begins, not in the mechanism, but in the perception of the mechanism. The system appeared conservative. It was not. It was yield-seeking across complex environments, without full transparency and without enforced constraints. This created a structural gap between what users believed and what the system required to function. That gap widened over time as yields remained high and confidence increased, but the underlying model did not change. It still depended on liquidity. That had not been secured, only assumed. Chapter 3, Capital Aggregation Engine. The system scaled through deposits. Retail capital flowed in continuously at increasing velocity. Yield drove that behavior. Higher returns attracted more capital. More capital increased perceived stability. This created a feedback loop, self-reinforcing. Deposits were pooled centrally, not segregated. All assets entered a single treasury. This mattered because ownership blurred. Individual deposits lost identity. They became part of a collective pool. From that pool, capital was deployed. across multiple channels: institutional lending, DeFi protocols, staking strategies, proprietary positions. Each allocation pursued yield, but introduced exposure. Capital was not idle. It was continuously in motion. This required coordination across timing, counterparties, and markets. Any disruption created friction. This is where scale becomes risk. As deposits increased, obligations expanded. Liabilities grew linearly, but risk grew non-linearly. Because deployment complexity increased and visibility decreased, the system relied on aggregation efficiency. Large capital pools improved access to opportunities and negotiating power, but also increased dependency on execution precision and counterparty performance. Yield distribution reinforced the cycle. Returns were paid regularly, predictably. This created trust and normalized the model. But those returns depended on performance and liquidity, not guaranteed cash flow. This distinction was not operationally visible. Users saw balances increasing. They did not see capital pathways or constraints. This is the core structure. Capital enters freely. It is pooled centrally. It is deployed externally. Returns are redistributed internally. That system functions under one condition: continuous inflow stability. If inflows slow, pressure builds. If outflows increase, pressure accelerates because obligations remain fixed, while capital becomes less accessible. This is where aggregation becomes exposure. The larger the pool, the harder it is to unwind quickly without loss. This is the transition point from growth engine to fragility amplifier. Chapter 4, the rehypothecation layer. The system did not use capital once. It used it repeatedly. This is rehypothecation. Collateral reused across multiple transactions, the same asset supporting multiple obligations simultaneously. This increased capital efficiency and increased risk. Deposited assets were not held, they were redeployed into lending agreements across institutional counterparties. Those counterparties reused the same collateral again and again. This created layered exposure, difficult to track and harder to unwind. The underlying mechanism was recursive. Capital entered the system once, but appeared in multiple positions, each generating yield, each carrying obligation. This created synthetic expansion, more yield, without more base capital, but that expansion required stability. Across all linked positions, if one failed, pressure propagated through the entire chain. This is the critical weakness: interdependence. Each layer relied on the next. For liquidity, for collateral value, for solvency perception. This structure obscured true exposure. Balance sheet representations appeared manageable because risk was distributed across layers but not reduced, only displaced. The system assumed collateral would retain value and remain liquid. That assumption mattered because liquidation timing became critical. If collateral could not be accessed quickly, obligations could not be met. This is where rehypothecation fails, not at creation, at unwind, when multiple claims converge on the same asset. At the same time, liquidity demand spikes, but supply does not exist because the asset is already committed elsewhere. This creates a bottleneck, invisible under normal conditions, but critical under stress. Rehypothecation amplified returns during expansion, but amplified fragility during contraction. This is the structural trade-off. Efficiency for stability, yield for resilience. The system chose yield and embedded fragility. Chapter 5, Hidden Fragility, Liquidity Mismatch. The system offered immediate access, but deployed capital long-term. This is a liquidity mismatch. Short-term liabilities, backed by long-term positions. Customer deposits could be withdrawn anytime. That was the promise. But underlying assets could not. They were locked in staking contracts, in DeFi protocols, in structured lending agreements, each with exit constraints, time delays, or market dependency. This created a timing gap between obligation and capability. Under normal conditions, it held. Withdrawals remained predictable, inflow offset outflow. Liquidity appeared stable, but this stability was conditional, not structural. The system required behavior, not safeguards. Users had to act predictably, markets had to remain functional, counterparties had to remain solvent. If any shifted, stress emerged. This is the hidden fragility. Liquidity was not stored, it was implied, based on expected flows, not actual reserves. There was no buffer, no excess capital held idle, because idle capital reduces yield, and yield was the product. So capital was deployed continuously, maximizing return, minimizing liquidity. This trade-off was embedded quietly. As long as withdrawals remained low, the system functioned. As long as markets remained liquid, positions could be adjusted, But when conditions changed, the mismatch was exposed, withdrawals increased, assets could not be liquidated fast enough, without loss, or at all. This is where pressure builds. Liabilities become immediate, assets remain delayed. That gap becomes critical because time becomes the constraint, not value. Even solvent positions fail if they cannot be accessed when needed. This is the difference between solvency and liquidity. The system confused the two. It assumed value equaled access. It does not. This is where the model breaks, not because assets disappear, because they cannot be used when required. Liquidity mismatch is silent until it is not, and when it is exposed, collapse accelerates. Chapter 6, Institutional Exposure and Counterparty Risk. The system did not operate in isolation. It relied on external counterparties and institutional borrowers, trading firms, liquidity providers. These entities received capital from the pooled deposits in large allocations. This created concentration. Exposure was not evenly distributed. It was clustered among a limited set of counterparties. This matters because failure is not linear. It is concentrated. The underlying mechanism was lending. Assets transferred in exchange for yield, collateral provided, but not always sufficient, and not always liquid. This created conditional security, not guaranteed recovery. Counterparties deployed capital further into leverage strategies, arbitrage, or directional positions, DeFi exposure. Each layer added dependency. The system now relied on external performance, not internal control. If counterparties performed, yield flowed. If they failed, exposure surfaced. This is where risk compounds. Indirect exposure becomes direct loss. The system assumed counterparty stability. That assumption was critical because there was no redundancy, no diversified fallback structure. If a major counterparty failed, capital recovery became uncertain or delayed. This introduces timing risk. Even if recovery is possible, it may not be immediate, and timing defines liquidity. This is the key linkage. Counterparty stress leads to delayed capital return. Delayed return leads to liquidity pressure. Liquidity pressure leads to withdrawal constraints. The system becomes reactive, not controlled. This is where visibility fails. Users did not see counterparty exposure. They saw yield and account balances, but underlying risk was externalized, distributed across entities they could not evaluate. This created information asymmetry, severe, because risk could not be priced or understood by participants. The system functioned on trust in counterparties and in the platform managing them. But trust is not a control mechanism. It is a placeholder for missing transparency. When counterparties came under stress, the system absorbed it immediately without insulation. This is the transmission channel. External failure becomes internal crisis, and once that begins, containment becomes difficult because exposure is already embedded. Chapter 7, the trigger, market compression. The system did not fail in isolation. It failed under pressure. Market conditions shifted rapidly. Crypto asset prices declined across major positions. Collateral values dropped immediately. This created margin pressure across lending relationships. Counterparties were required to post more collateral or unwind positions. Some could not. This is where stress begins, not at Celsius, at the edges of the system. DeFi protocols began to compress. Liquidity pools thinned. Exit pathways narrowed. Positions that were liquid became conditional or inaccessible. At the same time, volatility increased, price swings accelerated. This increased uncertainty and reduced confidence. Users reacted. Withdrawals increased, not gradually, quickly. This is the second pressure point. Outflows rise while asset values fall simultaneously. This creates a dual constraint, less capital and less liquidity. The system must now respond, but response capacity is limited because assets are deployed and counterparties are under stress. This is where the mechanism breaks. Collateral calls propagate across the network. One failure triggers another. This is contagion, not isolated risk, but interconnected exposure. Each unwind affects pricing. Each pricing shift affects collateral. Each collateral shift forces further unwind. This is a cascade, self-reinforcing and accelerating. The system now faces three conditions: declining asset values, increasing withdrawal demand, and constrained liquidity all at once. This combination is critical. Anyone could be managed. Together they cannot. This is the trigger point, not a single event, but a convergence of pressure vectors, market compression, liquidity contraction, confidence erosion. Once these align, the system transitions from stable to unstable very quickly. And at this stage, as control is lost. Chapter 8, Liquidity Crisis and Withdrawal Freeze. The system reached its constraint. Liquidity demand exceeded supply. Withdrawals accelerated faster than expected, faster than modeled. The platform faced a decision: meet withdrawals or preserve remaining capital. It chose preservation. Withdrawals were halted immediately. This is the inflection point. Access is removed, confidence collapses, the promise breaks. Funds were always assumed accessible. Now they were not. This reveals the structure. Assets existed, but could not be accessed. Positions were active, but could not be liquidated, not without loss or delay. This is illiquidity, not absence of value, absence of usable capital. The system attempted stabilization, pausing outflows, maintaining internal positions, avoiding forced liquidation, but the signal was clear. Liquidity was insufficient. Users understood immediately. This was not temporary friction. It was structural failure. The system could not meet obligations on demand. This distinction matters because trust is binary, accessible or not. Once access is removed, the system is no longer functional in its intended form. This triggers second-order effects. Market perception shifts. Counterparties reassess exposure. Pressure increases further, internally and externally. The platform is now isolated from inflows, from trust, from flexibility. It must now operate with constrained options and increasing obligations. This is the liquidity trap. Capital exists, but cannot move. Liabilities exist and cannot wait. That gap defines the crisis, and once reached, recovery becomes unlikely. Chapter 9, Collapse Mechanics. The system entered forced response mode, no longer controlled, only reactive. Assets had to be accessed. Under pressure, positions were unwound selectively, not strategically. This matters, because timing determines value. Under stress, timing disappears. Liquidations began into declining markets. This created price impact. Selling reduced prices further. Further declines triggered more pressure. This is a feedback loop, self-reinforcing and destructive. The system attempted sequencing, prioritizing accessible assets, but accessibility was limited. Many positions were locked or dependent on counterparties. Recovery slowed, while obligations remained immediate. This is the imbalance. Assets delayed, liabilities active. The balance sheet deteriorated, not instantly, progressively. Value erosion compounded. Across multiple positions, at the same time, counterparties began to fail or restrict capital return. This added another constraint. Capital expected back did not return on schedule or at all. This is contagion. External failure becomes internal loss. The system could not isolate risk, because exposure was interconnected. Every unwind affected another position. Every delay increased pressure. Every loss reduced flexibility. This is collapse progression. Not a single event, a sequence, each step reducing optionality until none remained. At this stage, insolvency emerges, not declared immediately, but implied. Assets no longer cover liabilities, under realistic conditions, not theoretical valuations. This distinction matters, because pricing under stress is different from pricing under stability. The system was valued as if markets were stable. They were not. This is where illusion ends, and reality enforces constraints. The platform transitions from operating entity to restructuring case, and once that transition occurs, recovery shifts from users to process, legal, procedural, and uncertain. Chapter 10, Regulatory and Structural Blind Spots. The system operated outside traditional banking controls. Not fully regulated, not fully unregulated. That this created ambiguity, a classification gap. It was not a bank, but behaved like one, accepting deposits, offering yield, providing perceived liquidity without regulatory requirements. No capital adequacy rules, no enforced liquidity ratios, no stress testing mandates. This matters because constraints define stability. Without constraints, risk expands quietly. Disclosure was limited. Capital deployment was opaque. Users could not evaluate exposure or liquidity position. This created information asymmetry. Severe. The system relied on trust instead of transparency. Regulators lacked jurisdiction clarity. Was this a security, a lending platform, a bank equivalent? The answer remained unclear. During growth, this delayed intervention. Because oversight requires definition, and definition was absent. This is regulatory arbitrage, operating between frameworks, avoiding strict classification while performing similar functions. This allowed rapid expansion without corresponding safeguards, but it also removed protections. For participants, there was no lender of last resort, no deposit insurance, no emergency liquidity facility when stress emerged. The system had no external support. It relied entirely on internal structure, which was already strained. This is the critical gap. Traditional finance absorbed shocks through layered defenses, central banks, liquidity facilities, regulatory intervention. This system had none. Failure was contained within the platform and passed to users and directly. This is the structural exposure, not just to market risk, but to regulatory absence. The system scaled like finance, but failed like an unprotected entity. This is the blind spot. Growth without oversight, yield without constraint, liquidity without enforcement. All three combined created inevitable failure. Chapter 11, Comparative Failure Pattern. This failure was not unique. It followed a known structure, a shadow banking pattern, yield-driven, liquidity-dependent, constraint-light. Traditional banks perform maturity transformation, short-term deposits, long-term loans, but with safeguards, capital requirements, liquidity buffers, central bank support. This system replicated the structure without the safeguards. That difference is critical because maturity transformation requires stability controls. Without them, fragility increases exponentially. The yield model created dependency on continuous inflows and stable markets. This is not new. It mirrors prior systems, money market stress events, structured investment vehicles, unregulated lending platforms. Each followed similar patterns. Capital inflows mask underlying risk until stress reveals it. The difference here was speed. Digital platforms accelerate behavior. Deposits scale faster. Withdrawals accelerate faster. Contagion spreads instantly across networks. This compresses timelines. What took months now occurs in days or hours. This reduces response capacity and increases failure probability. Another distinction, transparency illusion. On-chain data exists, but interpretability is limited. Complex structures obscure reality, just as in traditional finance, but with less standardization. This increases mispricing of risk. Participants believe visibility exists, but actionable clarity does not. This reinforces the pattern. Perceived transparency, actual opacity. The system combined multiple vulnerabilities: shadow banking structure, rehypothecation chains, liquidity mismatch, counterparty concentration, all operating simultaneously. This creates systemic fragility, not isolated weakness. Failure becomes inevitable. Once pressure reaches threshold, this is the pattern, not anomaly. Structure defines outcome. And this structure has failed before, under different names, in different markets, but with identical mechanics. Chapter 12, Operational Implications, Risk Signals. The failure provides clear signals, not theoretical, operational. These signals appear early, before collapse. The first is yield divergence. Returns exceed market baseline without transparent risk explanation. This indicates subsidy, not efficiency. The second is opacity. Capital deployment is unclear. Strategies are generalized, not specified. This prevents evaluation of exposure. The third is liquidity ambiguity. Withdrawal terms appear flexible, but underlying assets are undefined. This creates hidden constraints. The fourth is counterparty concentration. Large exposure to few entities without disclosure. This increases fragility. The fifth is dependency on inflows. Growth funds operations, not underlying profitability. This is structural reliance, not optional behavior. The sixth is rehypothecation exposure, collateral reused across positions, without visibility. This multiplies claims on the same asset. The seventh is absence of reserves, no idle liquidity buffer, all capital deployed continuously. This maximizes yield and minimizes flexibility. These signals combine, not in isolation. Together, they define risk. The system may appear stable while these signals are present. That stability is conditional, not structural. Operators must evaluate differently, not based on returns, but on access. Liquidity defines survivability, not yield. This requires reframing from performance analysis to structure analysis. Ask different questions. Where is the capital deployed? How quickly can it be accessed? Who controls its return? What conditions restrict liquidity? If these answers are unclear, risk is elevated regardless of yield. This is the key shift. From investor mindset into operator mindset, yield attracts attention. Structure determines outcome. Ignoring structure guarantees exposure under stress. Chapter 13, Strategic Defense, Operator Framework. Exposure must be reclassified, not as savings, as unsecured lending, and this is the starting point. Every yield platform carries counterparty risk, direct and indirect. The first control is allocation discipline. Limit exposure per platform, no concentration, even if yield is attractive. The second is liquidity prioritization. Evaluate access speed, not stated terms, actual exit capability, under stress. This defines survivability, The third is transparency requirement. Capital pathways must be understood, at least at a structural level. If deployment is unclear, risk cannot be priced. Avoid the position. The fourth is counterparty awareness. Identify who receives the capital and their risk profile. If unknown, assume elevated risk, always. The fifth is yield skepticism. Excess return requires explanation. If explanation is incomplete, the yield is compensating for hidden risk, not efficiency. The sixth is liquidity buffer strategy. Maintain external reserves outside the platform, accessible immediately. This offsets platform risk. The seventh is behavioral trigger monitoring. Watch withdrawal patterns, platform restrictions, yield changes, each signals stress early. The eighth is structural exit planning. Do not wait for disruption. Exit when conditions change, not after access is restricted. Timing is critical. The ninth is diversification of custody. Separate storage from yield generation. Do not combine functions. Control and return are different objectives. They must be separated. The 10th is assumption control. Never assume liquidity. Verify it continuously because conditions change without notice. This framework shifts behavior from passive participation to active risk management. The system will not protect participants. Participants must protect themselves. This is the operational reality. In unregulated financial structures, yield is optional, liquidity is not, and once liquidity fails, all other variables become irrelevant. Chapter 14, System Interpretation, the Real Failure. This was not a yield failure. Yield performed under normal conditions. This was a liquidity failure. Embedded in the design, the system appeared solvent because assets retained value on paper, but solvency is not access. That distinction defines the outcome. The model depended on continuous confidence and continuous inflows, not on internal liquidity reserves, and this is the core flaw. Stability was behavioral, not structural. As long as users did not withdraw, the system functioned. Once they did, it failed. This is a fragile equilibrium, sustained by inactivity, not resilience. The yield masked this condition. Returns created trust. Trust reduced withdrawals. Reduced withdrawals preserved liquidity illusion. This is the loop, self-reinforcing, until disruption. When disruption occurred, the loop reversed. Withdrawals increased. Liquidity declined. Confidence collapsed. This is the unwind, rapid and irreversible. The system did not break suddenly. It was always broken, but the break was hidden by inflows and pricing stability. This is why the collapse appears abrupt, but is actually delayed recognition of structural failure. Another critical point. Liquidity was treated as secondary, yield was primary. This inverted priorities. Correct structure requires the opposite. Liquidity first, yield second, because without liquidity, yield cannot be realized at all. This is the operational truth. Unrealized returns are irrelevant if capital cannot be accessed when needed. The system optimized for growth, not resilience, for yield, not survivability. And this choice defined the outcome and ensured it. Once stress conditions emerged, Chapter 15, Closing, Yield versus Liquidity Reality. The system promised yield. It required stability. Those are not equivalent conditions. Yield depends on performance. Liquidity depends on structure. This system prioritized performance and neglected structure. That decision defined the outcome. The model appeared stable because inflows masked fragility. Returns reinforced confidence. Confidence suppressed withdrawals. This created the illusion of sustainable yield. But the underlying requirement remained. Continuous liquidity availability, which was never secured, only assumed. This is the core lesson. Liquidity is not a feature. It is an engineered constraint. If it is not explicitly built, it does not exist. Yield can be modeled, projected, optimized. Liquidity cannot. It must be maintained under adverse conditions, not normal ones. This distinction matters because failure occurs under stress, not stability. The system failed the stress test before it was ever tested, and this is not isolated to crypto. The pattern repeats across financial systems. Whenever yield outpaces transparency, whenever growth outpaces control, whenever liquidity is assumed instead of verified, for operators, the implication is direct. Do not evaluate yield in isolation. Evaluate structure first, then liquidity, then counterparty exposure. Yield comes last. If liquidity fails, everything fails. Access disappears. Valuation becomes irrelevant, and recovery becomes uncertain. This is the hierarchy. Liquidity, then solvency, then return. Reverse it, and failure becomes inevitable. That is what this system did, and that is why it collapsed.